everyone, and welcome back to Lendy's monthly financial and property update this month. We're in September, and hopefully there's some light at the end of the tunnel for all of us in New South Wales and Victoria as we get closer and closer to those magical 80 and 70% numbers. So if you're in either of those states, we're with you, and hopefully we're getting close. In today's video though, we're going to be discussing loyalty tax, the impact of the lockdown on the rising mortgage stress, and of course an update on the current housing market. With us today we have our resident expert, David Hyman. He's our co-founder and CEO of the Lendy Group, so welcome back, Dave.
Thanks, Sarah. Great to be here again.
Cool, well let's dive right in. Last month we spoke about how the Australian property market showed some real resilience even under some of the strictest lockdown conditions. Maybe you can give us an update for September.
Yeah, absolutely. Look, the headline is that strength has continued into September, and we saw around 1.5% growth across all capital cities last month, according to CoreLogic. Important point to call out there, and I'll call out a couple of other things in a second as well, but important point to call out is we've seen months and months of growth, and when we're reporting on 1.5% month-on-month growth, that's compounded on top of the previous month. So even though we've seen some slowing that rate, we saw 1.8% last month. The underlying number is very, very strong, and obviously house prices have increased reasonably significantly over the last 12 months. And I guess off the back of that, we are seeing signs of it losing some momentum, but ultimately off a larger base. And if you sort of think about, a couple of things that sort of underlie that, obviously we've got really, really low interest rates, which are driving a lot of the demand. But in terms of, some of the things that might slow this down over time, if we look at the rate at which the prices have increased versus, say, wage increases, we've seen price rises increase at a rate 11 times that of wage increases over the last year. And that's a significant sort of headwind over time. It doesn't mean things will come crashing down. And obviously, the lower interest rates that we've seen means that that's not exactly how it's been reflected in terms of household repayments. But we see that as kind of a natural sort of speed limit, so to speak, in the coming months. In terms of how that's kind of gone around the country, we've obviously seen different lockdown conditions in different cities. So, while Sydney's got various settings depending on where you live, for the most part, outside of the local government areas of concern, there's been reasonably free activity within the property market industry. Open home inspections have still been able to continue. Auctions have still been able to happen off the back of it, albeit they've been online. And as a result, we've seen clearance rates in excess of 80%. In Sydney for sort of week on week for the last few weeks. That's also meant that stock levels have remained high, and albeit while listings are down, we are seeing quite a lot of off-market activity, and as a result, transactions and actual finance transactions are actually at record highs. So we've seen strong activity in Sydney. If we sort of look down at Melbourne's obviously had harder lockdown settings in place as compared to Sydney. They generally describe it as a hard lockdown. And up until recently, even property inspections on a one-on-one basis couldn't happen until recently. So as a result, we've seen both clearance rates drop, and they're down in the sort of 30 and 40% range, and also withdrawals from market happen. So, while that's not necessarily a positive story, I think as you alluded to before, Zara, we've now got some clear roadmaps out of both New South Wales and Victoria in terms of the pathway out of lockdown as we hit that 70% and 80% milestone. And obviously both cities have somewhat eased the restrictions over the last few weeks. And so as we saw last year, I think we expect there to be a reasonably strong recovery, in particular in places like Melbourne, because the underlying economy is being propped up by things like the monetary policy settings or the interest rates, as well as government stimulus. And we think that pent-up demand will kick in again, albeit not at a V-shaped level like we saw last year, given there's not as much uncertainty.
Thanks, Dave. Actually, some shoots of positivity there in the housing market as those restrictions slowly start to ease across those key states. But on the finance front, I have noticed, and I'm sure our watchers and viewers have also noticed, a number of articles out this month talking about homeowners being charged something called a loyalty tax. I know we at Lendy have spoken about this in the past, but with some studies are revealing that this is actually estimated cost of up to $9 billion. Maybe you could spend just a few minutes explaining what that loyalty tax concept is and any insights on that for us.
Yeah, absolutely. Look, simply the loyalty tax is the difference between what existing borrowers with a lender are paying and what that same lender will offer new borrowers. So to bring that to life with a real example, let's say you've got a lender that's offering new borrowers 2.2% variable rate on a particular loan. The loyalty tax is the difference between that and what they're charging on average the same type of borrower who's had that loan for maybe 2 or 3 years. And what we've seen in our data is we've seen that number as high as sort of 60 basis points based on new loans. Sometimes even increasing higher than that. And really, I think the call out for borrowers is while there's much that needs to be done at a government, regulatory, and even at a lender level. Really, as a borrower, you can actually sort of take control of this, and whether that's renegotiating the rate or whether that's refinancing your loan somewhere else, that can be a significant amount, as you described. Friends over at Athena recently did a study and estimated this across the Australian mortgage market to be over $9 billion worth of effectively loyalty tax that's being paid. So you break that down to an individual mortgage, and based on the average loan size of 400 grand in Australia, and loyalty tax slightly lower than what I described before, this would mean over the life of the loan, almost $40,000 more that borrower is paying. So it can mean a lot to your hip pocket, and with only a short amount of effort, you can actually sort of fix this yourself, either through renegotiating or refinancing. So, given lockdowns and all that sort of stuff, it's never been easier to do that remotely, and you can do that through platforms like Lendy or using a mortgage broker. But we strongly recommend you look at that because it's a big problem in the market and something that can be easily solved.
Really interesting insights there, and definitely something for a fair few of our viewers, I'm sure, to action. One point I wanted to touch on in this update with you is the rise in mortgage deferrals over the past month. So again, a lot of research this month, but around 40% of homeowners are predicted to be struggling to pay back their mortgages. What are your thoughts on how this extended lockdowns have had an impact on that, and any thoughts for those mortgage holders if they are suffering from that mortgage stress?
Yeah, absolutely. Look, I mean, it's reasonably an obvious conclusion that with the lockdowns, there's hardship that is put on individuals and businesses, and as a result, that creates mortgage stress. So if there's a number of industries that have effectively been shut down for almost 18 months across travel, tourism, and for hospitality businesses, it's been very, very stop-start. I think in Sydney in particular, businesses were just getting back on their feet in June, and then we've now been in lockdown for over 120 days. And while there's a pathway out, the underlying businesses, the business owners, the employees, they also need to continue paying their mortgages, and that's where mortgage stress comes in. And there's probably sort of two ways to look at this. So probably the first way is and this is probably the glass half full side, the banks are reasonably well versed at dealing with mortgage deferrals, given the rapid onset of this last year. And there's a well-trodden path with banks in terms of how to deal with this on a customer-by-customer basis. So my advice to the viewers would be, if you're in this situation and you haven't yet picked up the phone to the bank, and you're one of 40% of homeowners that are in mortgage stress, and that's what the research does say, it might not always be the right thing to do, but have a conversation with your bank and see what they offer around loan deferrals. Because it can just take that pressure off until you can open your shop up, or your business is going to be giving you work again. Or whatever the case might be. We know it's tough out there for a lot of people, but the banks can definitely help kind of get through that and make it one less thing to worry about. And the other side really of the coin is, as I mentioned before, both New South Wales and Victoria have a pretty clear roadmap out of this, and I think at a national level, there's now a playbook, so to speak, around the vaccination level. So I think I'm hopeful, and certainly it looks to be the case that as we come into 2022. There'll be a lot more certainty around this stuff, and I think everyone's kind of made their peace with living with the virus, subject to the strong vaccination rates holding true.
Thanks, Dave. I think that was a really important point for all our viewers to remember, is that the banks, they really are here to help, and no individual should really be roughing it or toughing it out on their own. However, if you're not feeling confident enough to go to your bank yourself, just remember that an experienced mortgage broker can definitely help you, and certainly our home loan specialists at Lendy are here to help with any advice on that space. So feel free to book an appointment with one of our home loan specialists, and they can definitely help if you're feeling a little bit of that stress. Also remember, we do have a lot of resources on this, our YouTube channel, and also on lendy.com.au on our blog, where we've got heaps and heaps of information about mortgage stress, the deferral process, what that might mean, but also what does a proactive refinance conversation look like, and is that potentially a way forward? So please feel free to jump on it. As I said, it's all free. Thanks so much, Dave, for joining us again this month. Hopefully next month we'll be doing this not from our home offices, but potentially from an actual office. To everyone who is still in lockdown, fingers crossed we reach those numbers soon. We hope you found this useful, and we look forward to seeing you again next month.